a 30-minute individual facilitation. So in this session, we're going to look at the relationship between the income statement and the balance sheet. So the income statement first communicates the inflows and also outflows of assets, where inflows are revenue. So revenue is income, which is inflows, and outflows, which generates outflows, which are expenses. So in order to make income, you need to generate expenses, which are outflows. So if there's an excess of inflows, so inflows is revenue, outflows is expenses. If there's an excess of inflows over outflows, it means it's called net income, so the excess over inflows over outflows. So it means that if revenue is more than your expenses, then it's net income. If it's the opposite, where if expenses are high and revenue is low, it means a net loss or a deficit. So obviously all goals for organisations want to make sure that they have more inflows, which means revenue, over their outflows, which is their expenses. So that's a profit maximisation. So the equation of the income statement or revenue statement is revenue minus all your expenses. So you have to add up all your income that has been generated from your business activities, less all your expenses, which are your outflows. So the income statement is a summary of all your revenue and expenses that you have incurred within a certain period of time. So it either results into a profit or a loss. So again, if your inflows exceed your outflows, it's a profit. If your inflows are less than your outflows and your outflows, which your expenses are more, then it becomes a loss. That's why it's sometimes called profit and loss statement as well. There's 3 types of names. So it's typically the period in 1 year, but it can be monthly, it can be weekly or quarterly, which is over a 3-month period. But the income statement is usually prepared for a period of time. So that's for example, what I say is the income statement of whatever business it is for the period ended the 31st of December 2010. So it's only particularly for a period for 1 year. And it's also always included into the title. So what is revenue? You might be thinking, okay, so revenue is just basically income. It's income that you generate from your business operations. It can include fee revenue that you get from your clients. It depends on what type of business operation you have, whether you're a service company or manufacturing company. So sale of goods becomes part of your revenue if you sell goods and you're in the retail sector. Whereas expenses have to be incurred. So expenses are things that you need to do in order to run your business successfully. You need to incur certain expenses such as salaries, so your employees, and also utilities like gas, electricity, and also water, and rent. So you rent the premises, and also any insurance that you might need, and office supplies like stationery and equipment are all expenses that you need to incur in running. And there's different types of expenses. Some are administration expenses, general expenses as well. So again, revenue is income from your business operations, and expenses for running of the business. So Pamela, can you please tell me what your definition of expenses are?
Is like capital expenditure, all outflows, and that sort of thing.
Okay, yeah. So in particular, what's an example of an expense? Another.
Like gas, electricity, insurance, rent, that sort of thing.
Yeah. Okay. What about revenue?
Revenue is income, and like it's total income, like sales and revenue, income sources, that sort of thing.
Okay, good. So what's your understanding of the income statement?
The income statement is also known as a profit and loss statement or a revenue statement. So it's all the income less all the expenses.
Yeah. Okay.
Which equals like a net profit or a net loss.
Yep. Or a deficit or surplus. Depending on when your inflows exceed your outflows.
That's right.
Okay, so that's what your income statement is dealing with revenue and expenses. Whereas the balance sheet is another report that people will do every year. And the balance sheet is basically what you own, which is your assets. So what you own is your assets. Like, you can own a car, that's an asset. If you own a house, that's an asset. So a company is everything that they own is asset. But it can be qualified in 2 types of assets. There's current assets and non-current assets. And current assets are cash, things that can be converted to cash within a year, such as accounts receivable, which we'll look at later. And non-current is over a year that can be converted into cash. And also, what the business owes is liability. So it's the opposite to assets. So assets is what a company owns, but liabilities is what we owe to our suppliers. And the difference is equity. So equity is, which is owner's equity. So owner's equity is the difference between your assets less your liability. So it's similar kind of concept as your income less your expenses, but in this way it's in the balance sheet, it's assets and liabilities. And therefore it comes to the accounting equation. The accounting equation can be written in many different ways, but the common way it's written is assets equals liabilities plus owner's equity. So your liabilities plus your equity should equal how much your assets are. And the balance sheet is a snapshot of the business organisation's assets, liabilities and equity at a point of time. So it's that's why it's called a snapshot. So it's a particular point of time. That's why it's prepared as balance sheet of your company as at, because it's a snapshot of that particular period of time, not for the year ended. So it's always as at, the 31st of December 2010. It's always included in the company's title. So we go down to, you're thinking, what are assets? Assets are basically resources that is owned by the company. Assets and resources such as cash that they have on hand, and also things that convert into cash, as I said before, accounts receivable. And accounts receivable, and what that is when customers purchase things on credit. They haven't paid us yet, they will pay us in the future. And it's a current asset because it can be collected within 12 months. If it's not collected, we go to a factoring company and get them to, go to the customers on our behalf and collect the money for us. Otherwise, it goes into doubtful debt. So accounts receivables basically can be converted into a year. And also we have fixed assets, which include office equipment and machinery, but they're non-current because they're useful and it's within a year that they can, beyond 12 months, that they can be converted into our cash. So assets, again, are what is owned, what the company owns. So inventory and accounts receivable and cash are examples. And then it comes down to liabilities. So liabilities, I said, are owed. What we owe. Not what we own, is what we owe. So we owe it to creditors. We also, such as creditors, include banks. So they might lend us a short-term loan. And again, liabilities are classified into current liabilities and non-current liabilities. Current liabilities is a short-term loan because we have to pay it within 12 months. And a mortgage is within 12 months, so it's a non-current liability. So they provide us with our loans, and also lending institutions as well, like merchant banks and various other type of institutions. And also suppliers, because they supply us with goods to run our business. So we also owe them money as well. That becomes a part of our accounts payable. So instead of accounts receivable, when consumers owe us, when we owe suppliers, it becomes our accounts payable. And accrual means you haven't paid it yet. So accrual hasn't been paid yet. So for example of an accrued liability is yearly taxes. So every year you pay your taxes. You don't pay it until it comes time, which is every year. And so that's liabilities. So liabilities is what we owe, not what we own. And our equity is the difference between the two. So equity is the difference between your assets minus your liabilities. So what you own, and that becomes the owner's share of the company, which is called capital, it can be called owner's equity, that sort of thing. So it's the difference between your assets minus your liabilities becomes your capital. So for example, if your assets of the company equal to be 50,000 and the liabilities were 30,000, that means your owner's equity would be 20,000. Okay, so for another example, what if owner's assets were 100,000 and liabilities were 80,000? How much owner's equity?
20,000.
Yeah, so how did you get that?
Assets less liabilities equals owner's equity.
Yeah, okay, very good. So there we come down to, what is the link? What is the relationship between the income statement and balance sheet? There is a link, because the balance sheet is called a balance sheet because it needs to balance. And for that reason, you know that if it doesn't balance, that it must be an error. So there is a link between, do you have any ideas before we go on to any ideas what the link might be?
If you
don't know.
The only thought is that the net profit, and that going
so that's good. So the link is obviously through the net income, so earnings for a period for the subsequent period. So it's either increases or decreases equity that results depending on the income statement. So that's why you prepare your income statement first. Must be prepared before your balance sheet, because whatever net income you get goes into the owner's equity in the balance sheet side.
Is it as retained profits or
no? As retained earnings, no, it comes as net income.
Okay.
So whatever you own, so if the balance sheet doesn't balance, there might be an error in the income statement. So the net income goes straight into your owner's equity over a period of time, and it can be into retained earnings as well. And the income increases in the owner's equity's claims against the assets. But then again, Do you think income is a cash asset?
Well, cash